The world around us is ever-changing. We are facing development challenges on a global scale. Today, 41 million out of 57 million deaths are attributable to non-communicable diseases. In the Philippines, 5 out of 10 families were deprived of basic education. The Philippines also ranked third in the top 10 countries with the most natural disasters. Women participation in the labor force is less than half at 48%, while male participation is at 77%. The United Nations identified and adopted 17 Sustainable Development Goals, or SDGs, to address the challenges faced by economies, societies, and the environment. We at ATRAM support the UN and the SDGs by launching the ATRAM Philippine Sustainable Development and Growth Fund. The fund is designed to invest in Philippine companies that score high in terms of the integration of UN SDGs into their operations and strategy. Through this fund, we hope to encourage PSE-listed companies to integrate UN SDGs into their businesses. We must work together to make a world a better place. ATRAM Philippine Sustainable Development and Growth Fund. Invest in a sustainable future together. Invest to thrive. Invest together. For more information, visit www.atram.com.ph.
Good morning, everyone. Thank you for joining us. I'm Therese Angangco, so I'll be our host for today. I am an alternatives analyst for ATRAM. And like many of our neighbors in the ASEAN region, our Philippine stock market, was affected by the global pandemic. Market volatility can be quite unnerving, but it does come with the cyclical nature, of the market. And these are the moments, we really have to prepare for. So, with these low moments, we know that they've always been followed by recoveries. And that's, what our whole webinar will be about. With businesses trying to get back on their feet, history has shown that market always bounces back and continues its upward trajectory. So thank you so much for attending. Today's webinar will focus on the local equities market in relation to recovery and how investors should be thinking about 2021 and beyond. So if you have any questions, please send them as early as now by clicking on the Q&A button down below. I think some people have already sent in, so thank you so much. We are reading those already. Before we begin, I'd like to let you know that this session will be recorded and that copies will be disseminated as well as posted on all our social media platforms. So also, please don't forget to visit our website, atram.com.ph, for more detailed information about all the funds that we offer. So if you have any friends who you think would like this webinar but are unable to attend, please feel free to share the YouTube replay of the session and visit our YouTube channel, ATRAM Studio, so you can scan the QR code to visit our official media pages. So we really want you to be informed, and we have all the channels set up for you so you can be the best and most informed investor that you can be. So we also want to invite you to join ATRAM's official Viber community group, #ATRAMPH community, to stay updated on the latest announcements, advisories, and reminders. You can also scan or take a picture of the QR code or visit the link on your screen so you can get a chance to win ATRAM merchandise. Ew, I like that. Okay. We would also like this webinar to be as interactive as possible. So again, please don't hesitate to send your questions in the Q&A all throughout the webinar. We'll be filtering those, or if we can't answer you now, we might be able to answer you later. So each question you send in is a raffle entry for a chance to win limited ATRAM merchandise. So winners will be announced at the end of the webinar. So make sure you stay until the end. We'll also be wrapping up with a quick feedback survey after the webinar. So we really hope you can share your thoughts with us about our session today and how we can further improve our webinar series. So any thoughts, comments, suggestions, we'll be really happy to hear all about them. So today's speaker is Carlos Navarro. Carlos Navarro is currently a portfolio manager in the ATRAM Equities team. He was previously the portfolio manager for equities in the trust banking group of the second largest local bank in the country. He has 8 years of experience in the fund management industry He holds two master's degrees. The first is a master's degree in management with the University of Asia and the Pacific. And second is a master's degree in computational finance with De La Salle University. So now let's all welcome Carlos. Hi, Carlos. So the floor is yours. I'm so excited to hear all about it.
Hi, good morning, everyone. Thanks for listening in. To start off, let us now give just a quick market review on what happened for the past couple of years. So as we can see here, we have actually been an uptrend since the market bottomed out in March last year. We bottomed out around the 4,000 levels back in March last year, and we have been on an uptrend ever since. And right now, we are already hovering at around the 7,000 resistance. So we're seeing a pretty resilient market. And this is despite the various lockdowns and the all-time high cases that we've been seeing lately. So a good reason for the continuing resilience of our market will be in the next slide. We are showing you the reaction of the PSEI every time a lockdown is announced. So let us first start off with the first lockdown that was announced. It was in March 15, 2020, where an ECQ lasted for about approximately a month or a month and a half. So now, in just 1 week, the market went down by almost 25% during the announcement. Now, that is actually the steepest PSEI drop in history. Because, for example, in the global financial crisis, the market went down about 50%, but it was a span of 1 year. But here, we went down by almost 25% in just a span of 1 week. So that makes it the steepest PSEI drop ever. Now, the next lockdown was already March of this year. Just a quick note, the lockdown in August of last year was an MECQ. It's not an ECQ. So we don't include that into the equation because we want to include only the strictest form of quarantine, which is the ECQ. So now the next ECQ, the second ECQ, is during March until the first week of April. And now the market went down by 1.35%. Now that's actually a lot better than the 25% drop that we had last year. And now the current lockdown that we had that was announced back in August, after 1 week, the market actually went up by 5.6%. So as we can see here, there's still an effect when lockdowns are announced, but the effect is continuing to decrease moving forward until to the point that we actually went up by 5.6% in the last ECQ announcement. And I guess a good question for that is, why has the market been resilient despite these various lockdowns and despite the all-time high cases? Here in this slide, we can see two charts, but let's first focus on the chart on the left-hand side of the slide. We're showing you here the percentage of deaths, the number of deaths as a percentage of COVID cases. Now, as we can see here, the percentage of deaths has actually been lower compared to what it was earlier this year and last year. And that has been partly due to the vaccine rollout. Now, let's take UK as a perfect example for this. The UK has a good portion of its population that's vaccinated already. Now, we are seeing also the same thing happening in the UK as ours, because the percentage of deaths is actually also low. They were able to maintain low death rates per day, just like ours. And it's really because of the vaccine rollout. The higher the percentage of the population that's vaccinated, the lower this figure would be. And that is what we are seeing. And this just goes to prove how important the vaccination rollout is. Okay. Now, if we focus on the right-hand side of the slide, we're looking at the COVID situation index, which was created by ATRAM. And I like this chart because it combines all of the major factors and it measures how well we fared against COVID. So it combines mobility, vaccination, healthcare capacity, and mortality. Now, the thing about this is, if we can see back in August and September, just recently, there was a dip. But the good thing about it is the dip is actually much much higher. We are at much higher levels in the COVID situation index compared to what we were back in April of this year and compared to July of last year. And the main reason for that is despite the all-time high cases and the increased and the healthcare capacity reaching critical levels, it was more than offset by the mobility and the better vaccination rollout, and of course the lower mortality rate. So that just goes to show how important the vaccination rollout is, not only for the recovery of the economy, but for our overall health as well. Now, in this next slide, we are showing you the impact of the foreign flows on the PSEI. Now, let's focus on the blue shaded columns here. I have encircled those in green where we had a huge foreign inflow. So this just basically shows you the net foreign inflow that we had during that specific year. So let's first start off in 2012, where we received a foreign inflow of around $2.5 billion. The market was actually up by 33% on that year. Now for 2014, we also received another huge inflow, and the market was up by 23%. And in 2017, another huge inflow for us, and the market was up by 25%. So in contrast, let's now focus on those encircled in red. Back in 2015, we received a huge net foreign outflow, and the market was down 4%. In 2018, another huge foreign outflow, and we were down by approximately 13%. And in 2020 and 2021, for 2020, we were down by 9%. And for this year, we are still down year to date. So that just goes to show you how big of an impact foreign flows are on the market. While it is not the single factor that determines the direction of the market, it certainly has a big influence, since foreign funds account for approximately 50% of market activity. So now, as we can see here, for 2021, we are still on a net foreign outflow year to date at around $1.6 billion. But there's a silver lining here. Since November of 2019, we have been on a net foreign outflow streak for 21 straight months. But this was finally broken in August, as we finally received our first foreign inflow in 21 months. Now, that's a good sign, although we can't really say for sure that foreign funds have decided to come back in our market. But still, hopefully, this is a signal of better things to come. So for the next slide, we are showing you our earnings growth assumptions for both 2021 and 2022. So let's first focus on the 2021 column. We are expecting a 30% earnings growth for 2021, and two sectors will drive those earnings. And number one, it's the property sector, which will contribute 6% out of the 30%. And the next one is the conglomerate sector, which will contribute 10% of the 30%. So taking those two together, that approximately accounts for a little over half of the earnings growth for 2021. Now for 2022, we are expecting a 43% earnings growth. By the way, just a quick side note, the earnings growth that we are mentioning right now takes into account already the new index constituents. If we remember back in August, DMC and Emperador were booted out of the index and were replaced by Converge and ACEN, or AC Energy. So all of these earning assumptions take that into account already. So going back to 2022, as was mentioned, we are expecting a much stronger 43% earnings growth for next year. And same as 2021, the two biggest contributors are properties and the conglomerate sector. For the properties, they are contributing 12.3%. And for the conglomerate sector, they will contribute almost 18%. So that's about 60% already of the earnings growth that we expect for next year. And the way we are positioning our portfolios is on a stock selection basis, so that we would be overweight in those stocks that would contribute most to this earnings growth. So we are expecting a better earnings picture for next year. Instead of being caused by a low base, the better earnings outlook for next year will now be demand-driven. So this takes into account now the last slide, which we use. The earnings growth is one of the major factors that we use in determining our index targets for 2021 and 2022. So now in this last slide, let's focus on the upper right-hand corner. We are targeting 7,620 for 2021. Now that's based on a 17.1 times PE, and that's below the 10-year average PE. Now, the reason why we want to use a multiple that is below the 10-year average is we haven't reached herd immunity yet. So there's still a lot of risks right now, possible lockdowns. But I think despite that, our target of 7,620 is already around a 10 to 11% upside from current levels. So that's actually pretty good considering that we're already being on the conservative side when it comes to our estimates. Now for 2022, we are targeting, to be exact, 8,680 or almost 8,700. Now that is based on a 19.5 times PE, which is simply the 10-year average pre-pandemic. Now, why are we using a higher multiple and arriving at our target? That's because we are assuming that for the NCR region, we will already be reaching herd immunity by the end of the year. And I think that's plausible because currently 46% in the NCR are already fully vaccinated. So reaching 70% by the end of the year, I think it's more than realistic to do that, given that approximately 1/3 of the vaccine rollouts per day goes to the NCR region. Now, another assumption here is that for next year, we think that the whole country will achieve herd immunity at the very least by the first half of 2022. So those are the main assumptions that we have in reaching this target at 8,700 approximately. So that's a good 27% upside from these levels. Now, if you're going to ask if there are risks to our assumptions, definitely there are risks. One risk is the upcoming elections, of course. If there's any instability in those elections, I think the probability of that is low. But if that does happen, that will be a risk to our assumptions. And the other one is really the vaccination rollout. That's the single biggest factor in our assumption. So any delay regarding a herd immunity will also affect our assumptions. But I think the way we are looking at it right now is the rewards really outweigh the risks at this point. The probability of us that we're going to have an unstable elections, that there will be a delay in the vaccine rollout so that our herd immunity will be pushed back in the second half of next year instead of the first half, I think those are really low. I think the catalysts right now are strong enough to justify the 8,680 levels. I think this is more than achievable. We have a good earnings outlook, strong earnings profile, which now will be demand driven rather than because of coming from a low base the previous year. So now the question is, when do we invest in the equities market? I think now is the perfect time to buy into the equities market since we are correcting already from the 7,000 levels. And considering we have a 27% upside from current levels to our target of 8,680 next year, this will be a good time to invest in the equities market. And we have all kinds of products to suit your needs. So you can do it, for example, regularly on a monthly basis or on a weekly basis, depending on what you're comfortable with. And regarding the volatility, I just suggest that we don't focus on the volatility. That will be part of the game. That will never go away. So I guess one way to look at it is from a quote by Warren Buffett, where he said that the stock market is a device to transfer money from the impatient to the patient. So wise words from the world's greatest investor, and it's good that we heed his advice. So thanks again, everyone, for listening in, and I can now take questions from the audience.
Thank you so much, Carlos. I definitely learned so much. Wow, a 43% earning growth for 2022. That's huge. ATRAM has a wide range of investment products, as you've said already, Carlos. And our capabilities span across several asset classes meant to service the different investment objectives of each individual. So it's best to know which one is the best for you, and you can check out our website. And with all our products, it is with great pride that we announce that ATRAM has actually received and achieved 9 industry awards for 2021. For 2021, that's an incredible feat given the volatility of our market, right? So we have the best local fund house in the Philippines, given by Asian Investor, the fastest growing fund management company in the Philippines, given by the Global Banking and Finance Awards, and by the Global Economics Awards. We have the most innovative mutual fund offerings, again by Global Economics Awards, the best investment solution provider from World Business Outlook, and the most innovative asset management company from Pan Finance Awards. And lastly, the ATRAM Total Return Peso Bond Fund was named as the best management fund by the CFA Society of the Philippines for 2021. So that's really incredible having all these awards. We have also been awarded the Editor's Triple Star as well as ATRAM Wealth by the Asset AAA Private Capital Awards for integrating ESG or the environmental, social, and corporate governance in our investment process. So for today's session, we really hope we somehow assisted you to hashtag take on tomorrow by investing your hard-earned money with an award-winning fund house. So for more information about ATRAM, please visit our website, atram.com.ph. And at this point, we'll move on to our live questions from the audience. So we have a lot throughout the whole process. So, okay, as to start it off, Carlos, which sectors do you think will drive the market recovery?
Yeah, hi. Good question. I think that was part of one of my slides a while ago. So
Yeah.
let me just reiterate it. So the two sectors that we think will drive the market recovery will be the property sector and the conglomerate sector. So we're expecting a 43% earnings growth for next year. Now, around 60% of that will come from the properties and conglomerate sector. Now, for the conglomerate sector, the main subsidiaries of these conglomerates are really the banks and the property companies. So whatever happens to the banks and the property companies, that will also be reflected in the earnings of the conglomerates. And that's why we're seeing the bulk of the earnings growth will be coming from the conglomerate sector. Now, for the property sector, there are a lot of constraints right now, for example, on residential development because of construction capacity. Right now, construction capacity is only at 50%. So that's way off from pre-pandemic levels. That's why we're seeing the property sector really lag right now in terms of earnings. Another thing is the malls. Because of the restrictions, there have been, low foot traffic in the malls. But of course, the main reason why we're assuming that they will be the drivers for next year is because we are assuming that herd immunity will already be achieved next year by at least the first half of next year. The most bullish assumption that I've heard is around March, but I think the consensus would be around May or June for achieving immunity. And because of that, we'll be seeing an immediate resumption in construction activities. So that will benefit the property companies and also the malls. We can expect the foot traffic to come back to pre-pandemic levels pretty quickly once we lift all restrictions. And that's the reason why we think both the properties and the conglomerate sector will drive most of the earnings growth for next year.
Okay, thank you. That was a really comprehensive answer. So property and the conglomerates. So second question, I'm already an investor in your equity mutual funds. When should I add significantly more? That's a good question.
Yeah, that's a good question. I think now would be a perfect time, especially since we're looking at an 8,680 target for 2022. Of course, you don't have to do it in one go. That's what I would discourage that. But what you can do is do it on a regular basis. If you want to invest probably weekly, monthly, quarterly, it's really up to your liquidity requirements. So there's no one standard answer for everyone. But what I suggest is you start now and you do it on a regular basis depending on your financial needs.
What other positive factors should we look into in the Philippine equity market once the economy reopens?
Oh, there's a lot of things to look forward to when the economy reopens. So
Yeah.
you know, we've been hearing these terms such as, revenge dining, revenge travel. It's really up to us whether we believe that or not. But I think the main point is we will see an immediate resumption in consumer spending there. So
Mm.
definitely travel will be one of them. Dining will be one of them. Like I said, construction activities will be one of them. And since two-thirds of our economy will come from consumer spending, we also expect lending loans to come back. Since of course companies will be on an expansion mode again. So definitely a lot of things to look forward to. So from construction to loan growth to travel to dining, those are just some of the many factors that we're looking at.
Right. Yeah. Should I be concerned over the property sector concerns in China now? Ooh, I know we've been discussing this internally a lot.
Yeah. Um if that person is asking about the Evergrande company,
Mhm.
then then I don't think we should be worried about that because what people are mostly worried about, that's why we had the correction, for example, in the US and European markets, was it's going to be a systemic risk. Like it would be a China slowdown. But
Right.
we have little exposure in terms of the listed companies.
Mm.
There's some companies that have exposure, such as SM Prime, Jollibee, and Robinson's Land, but these are really small exposures. So it's nothing really big for us to be worried about. And of course, if we talk about the economy in general, we're not a trade-oriented economy. Two-thirds of our GDP comes from consumer spending, just like the US. So we're not trade-oriented like Australia, Thailand, Japan, South Korea, Singapore, or what have you. We're not trade-oriented. In fact, the trade contribution in our country in the last GDP print, which is second quarter, is actually negative 10%. So it's not something to worry about because we're
Mhm.
not oriented. Our GDP is mostly driven by consumer spending. So I don't see any systemic risk there.
Right. Okay, that's great to hear. What do you think is the difference if you invest now during the pandemic versus waiting until it'll like normalize again?
Well, I suggest that we invest now because if we wait for things to normalize, the market would have gone up already.
Right.
Uh,
Yeah.
like for example, a perfect example of this would be back in 2020 when the market went down to as low as around the 4,500 levels on a closing basis. So if we waited until the pandemic to be over, until now it's still not over, right? I mean, it will probably be over next year. So if we wait, we would have missed that run up from 4,500 to almost 7,000 today. So the market is always forward looking. So you don't wait for the market, for the economy to finally recover or to go back to pre-pandemic levels. You invest now in anticipation of that recovery because the stock market is always 12-month forward looking.
Yes, I agree. I agree. What are your considerations in buying stocks in general?
It's mostly research driven. We here in
Mhm.
ATRAM
Yeah.
really put a premium on a research driven process. So it's really a lot of number crunching. We take a look at the financial statements, we meet with the companies, we take a look at their projections, we make our own projections depending on our assumptions on how the industry will perform moving forward, on how the company will perform moving forward. So it's really a research driven process. It's mostly fundamental analysis. For technical analysis, we just do that for timing. But I would say that 90% of our decision making would really be fundamental analysis. A lot
Mhm.
of communication between us and the corporates, and a lot of number crunching from the financial statements, and analyzing the industry and the company trends as well.
Yes. Yes. How many more years do you think the stock market will reach its full recovery? Hmm.
Okay, I'll try to rephrase that question. If the question is when we will reach pre-pandemic levels,
Mhm.
is the question, then I would say next year, because we are targeting 8,680 for next year, and
Yes.
pre-pandemic levels was around 7.5, 7.6. We'll breach that already by next year. And if the question is regarding the economy, I think a safe bet for us to reach pre-pandemic levels would be the last quarter of 2022 or the first quarter of 2023.
Mhm. Okay, so around a year and a quarter.
So the market will move ahead from the GDP print. So because the GDP is a lagging indicator, the market is always
Yes.
forward looking. So the market will definitely be ahead of that.
Mm-hmm. What are some tips on how to invest at ATRAM? So many ways.
Oh yeah, it depends on what you on your preferences, because we have, for example, if you're ESG focused, we have the SDG fund.
Mm-hmm. SDG fund.
Growth stocks, yeah, we have the strategic growth. We also have the alpha opportunity for those who really want high alpha, are able to absorb the volatility. So that's one of the good funds that we have. And we also have dollar denominated funds. And we also have the index tracker fund. So
Mhm.
there's a lot of ways to invest depending on your preferences. So just visit our website at atram.com.ph to see more of our products as well.
Yeah, there are really so many. I'm so happy you can choose from different kinds.
Yeah.
Really made my investing life so much easier. What is your end of the year PSEI outlook? Do you think we need the foreign participation to get at those levels? Oh, that's interesting.
No, I don't think so. The market has been pretty resilient despite the foreign selling. I
Mhm.
mean, of course, it would be good if the foreign funds come back,
Right.
because it's the foreign funds, the foreign flows. It's a big factor, but like I said, it's not the only factor. The one thing that we have to note is that local participation has been increasing already throughout the years. I think before, local participation was only around 35%. Now it's probably 50 to 60%, or probably even more during some days. So the effect of the foreign funds, it's now decreasing because the purchasing power of the local funds are now increasing. So I don't
Mhm.
think we need the foreign funds to come back, but of
Yeah.
course it would be a big help. It would be a big help. No, I don't think that would be a requirement for us to hit our index targets for this year.
Okay, that's great. That's great to hear. What do you think the impact of the upcoming Philippine elections will be to the Philippine economy? Hmm.
Well, the usual effect is that on the consumer front, there will usually be benefits, for example, to stocks such as URC, Pure Gold, Emperador, RHI. Those who have exposure in the supermarket business, or those staple products that politicians like to give away. So
Mm.
there
Mhm.
will be there. They usually give out, for example, alcohol, a
Yeah.
Jollibee takeout or Chowking
Yeah.
takeout, what have you. So definitely there will be an effect. But if you're asking whether the effect will be the same as in the previous elections, the answer is no, because of the restrictions in the pandemic. So
Mhm.
there, of course, I don't think there will be, mass rallies, mass gatherings that we've had before. So it will be muted to a point. The elections effect will still be there, but it won't be the same magnitude as it was before.
Right. Yeah, I agree. Next question is, if foreign funds is a big factor in the index, why are we up while foreign funds are still leaving PSEI?
Well, yeah, I think I addressed that a while ago, but just to reiterate what I said. Yes,
Yeah.
it is a big factor, but it's not the only factor. And
Yes.
also that we're still down year to date, and that's mostly because of the foreign funds. We're still down. So, but that's not the only factor. Like I mentioned a while ago, the power of the local funds, of the domestic investors, especially the retail investors. That's something that's really been something new during the pandemic. Retail investors are now account for a good portion. Retail investors and the local funds now account for a good portion of the market activity. So To answer the question, the market is still down, but no, we don't need that anymore because of the increasing power of the domestic investors, both the funds and the retail investors.
Mm-hmm. Right. Okay. Next, as a college student looking into invest, can you give any advice on starting to on investing? Great question. Great.
Yeah, sure. There are a lot of ways to do that. I mean, especially online. You could go, you have a lot of resources online, whether you want to go to YouTube, whether you want to go to Coursera or any of those online trainings, there's really a lot and it's all free. So I think what I suggest really is for you to get started on fundamental analysis, get familiarize yourself with terminology such as, for example, price to earnings, price to book, what it means. Is it good to buy cheap, or is there a reason why the stock is cheap? You'll know that once you study fundamental analysis, and I can assure you the material that is available online, it's infinite and it's free. So just go online, search for any online courses on fundamental analysis, and you'll be well on your way. But of course, if you can also do technical analysis, again, same as fundamental analysis, these charting technicians, even if you just go to YouTube, there's a lot of material there. So you can search everything online and you'll be okay.
Yeah, definitely. I think the GCash ATRAM funds were really the such a gateway way to invest. Like sometimes you just have to start doing it. I think it's only like 50 pesos. Just put 50 in there and
Exactly. I have a lot of friends who never invested before, but because of ATRAM's partnership with GCash, they are now actually investing.
right. Same.
So it was really a big boost.
Yeah, sometimes you just gotta do it. So just put 50 in there.
I agree.
Yeah.
I agree.
Okay, last two questions. NEDA has released a report saying that financial investments may take up to 10 years to catch up to pre-COVID-19 trajectory. As an investor, should this be a source of worry for Philippine equity recovery?
I think the NEDA report was pertaining to travel. I read that report.
Yeah.
If the question was is pertaining to the report that was released a while ago, I think that was really on travel alone, not really the economy in general. I don't think that's the way that that was the message of NEDA. So based on that article, yes, in terms of the travel industry, that it would take financial investments up to 10 years to recover. Now, of course, again, that's not something that should really worry us because, for example, back in I think it's 22. I just want to make sure that I get my figures correct. I think based on fourth quarter GDP, fourth quarter of 2020, the contribution of travel is only around 6%. Obviously, it's much higher than that pre-pandemic levels. But again, the main message here is that we are a consumer-driven economy.
Yes.
2/3 of our GDP comes from consumer spending. So if the outlook there is bleak, then that's something for us to worry about. But for travel, these are just really the financial investment side. That doesn't mean that people will not travel. So we have to separate the financial investment side in the travel industry to people actually wanting to spend for travel. Those are two different things. So I still think we are in a good place to recover next year.
Right. Yes. For especially for Philippine equity recovery, yeah, we don't think it's gonna affect it too much.
Correct.
What needs to happen for the foreign outflows to reverse?
Now that's a good question. It probably boils down to our handling of the pandemic. But by the way, like I mentioned a while ago, we already had a foreign inflow in August. So foreigners are starting to come back. Now, if it's sustainable, I think we really have to sustain the improvements in the vaccination rollout. And we have done that actually. From April, we had a daily vaccination rate of only around 10,000, and projections would be we would reach herd immunity by 2026. But now the vaccination rate has now been close to 400,000 a day. So I think the foreign starting to take notice of that, and that's one of the reasons why I think the foreigners have come back starting August. Of course, it doesn't hurt that most of the foreign funds that went in really invested in the telco sectors such as Converge and Globe because of the GCash. So I guess regardless of the reason, they have come back in August. Now, whether that would be sustained or not, I think will be determined if we can sustain this improvement in the vaccination rollout, which so far we have been able to do.
That's great to hear. Okay, very last question. The projections you show seem to be very optimistic. What would you consider as a possible downside events to these projections? Vaccine supply anew, or COVID variant, elections, social unrest? Which one do you think is the biggest catalyst for that?
Yeah. I see two risks to that. The first risk, I think, which will be very minor, but it's a risk definitely, would be elections. I think any instability in the upcoming elections would put a dampener on our outlook, of course. That will cause, any instability in the elections would cause social unrest. That's something that we do not want. Political instability, that's something we do not want. But as for that happening, I think it's unlikely. But of course, we are aware of that risk. But I think the major risk to our assumptions is really the vaccination rollout.
I agree.
Right now, we're all of our assumptions, all of our targets, it hinges on the vaccination rollout, which is the single biggest factor, not only for the market's recovery, but for economic recovery as well. For example, the base case is that we'll reach herd immunity by the first half of next year. If that is pushed forward to the second half of 2022 instead of the first half, that's something that, of course, would affect our assumptions, and we would have probably revise our targets lower, definitely. But given what we see now, we don't see that happening. Our vaccination rate has been steady at 400,000, even to the point that the NCR would reach herd immunity probably by December. The government is even more optimistic. They would say that herd immunity can be reached in the NCR by November. And based on those signs, while it is possible, we think that it is unlikely. That's why we are optimistic in the market for next year. Perfect example of that is, for example, the NCR. That's why I keep on mentioning NCR is NCR accounts for about 1/3 of the GDP. Now, if you add the Calabarzon area to the NCR, that would be close to 50% already. So, very bright outlook in terms of the vaccination rollout. There is a risk, definitely. I don't want to paint too rosy a picture, of course. There are risks in the market. But at this point in time, I just believe that their rewards outweigh the risks. And the possibility that we will be able to maintain this improvement of the vaccination rollout is really bound to continue.
I agree. So thank you so much, Carlos. I think that's all the time we have now for questions. But before we wrap up, any last words, Carlos?
Yeah, everyone, I would like to thank you for listening in. It's really been a pleasure. Just also want to add that please check out our equity funds in atram.com.ph, whether it's ESG, growth stocks, non-index names, or index trackers. We have that here in ATRAM for you. So again, I want to thank everyone, and I hope to see you soon in our next webinar. Thank you so much.
Thank you so much, Carlos. I really learned so much. And of course, thank you to our audience for listening, staying this whole time. And wow, 43% 2022 earning growth is huge. So many things to look forward to. And I think our main takeaway, or at least my main takeaway, is that our local equities is on an upward trajectory, right? Driven by demand, by consumer demand. And right, we know the property sector and conglomerates have very high growth, but again, conditioned on our vaccination rates and herd immunity. So, those are the biggest contenders that we see affecting our equities market. So we appreciate you taking the time to join us today. We hope you were able to gain lots of insights and key takeaways from today's webinar. So now did you know that for as low as 1,000 pesos, you can already jumpstart your investment journey? So I know it's been like such a great way for me to invest as well. So here's how you can invest in ATRAM funds.
Hello. To open an account with ATRAM, just visit our website at www.atram.com.ph. Here, you can learn more about all the funds and services that we offer. Our site will then guide you to our online investment platform, Seedbox, where you can start investing for just 1,000 pesos. But if you have more questions, visit the website's Frequently Asked Questions page or ATRAM Academy page. Thank you.
Okay, I hope you learned a little bit about how to invest with us. So if you have any more questions or would like to learn more about ATRAM, please visit our website, atram.com.ph. So again, if you have any friends who you think would like this webinar but are unable to attend, feel free to share the YouTube replay of the session, visit our YouTube channel, ATRAM Studio, or scan the QR code to visit our official social media pages. So we would also like to invite you to join ATRAM's official Viber community group, #ATRAMPH community, to stay updated on the latest announcements, advisories, and reminders. So you can scan the QR code. I suggest you take a picture of it or visit the link found on your screen and get a chance to win ATRAM merchandise. So lastly, please answer the survey if you could so very much. At the end of the webinar, we would love to know your thoughts on today's topic and really hear more suggestions and things you want to know about for future webinars. So on behalf of everyone at ATRAM, thank you again for your attendance and participation. We wish you and your loved ones continued health and safety. Have a great day. Thank you.